Hi, everyone. Hello, and welcome to our 111th Raid the Fridge. It's so nice to see all of you here. I see familiar faces. Hi, Eric. Nice to see you again in person. Or Suki, and a lot of fresh faces joining us tonight. So my name is Pia Bernal. I'm Kickstart's community manager and tonight's fridge master. So tonight's fridge Raid the Fridge is once again a hybrid execution. So we have also guests joining us on Zoom. So let me just grab a sec to say hello to our guests in Zoom. Hi everyone, thanks for joining us online. So for our online guests, just make sure to send in your questions via the chat box if you have any, and we'll get to it. Okay, so before we introduce our speakers, a few reminders, of course. We are recording this session. We are live streaming this session on Facebook's Kickstart's Facebook page at KickstartPH. I told you where to get beers, and if you need to go to the washroom or the toilet, just please proceed to that door and take the stairs, and you'll find the restroom. So let's dive in. Our speaker tonight flew in, especially from Singapore, and they're here on a mission to find out more about the Philippine startup ecosystem and, of course, learn from you and also from our audience online. And they'd like to share with you the work that they do at Vertex Ventures, and as well as share some of the lessons learned that they've gathered over the years with tonight's exciting topic, debunking 10 myths around Series A fundraising. So I hope you guys have a lot of questions to Pui Yan later. So, of course, tonight's program is not just us talking in front. This is a two-way conversation. So please feel free to raise a hand if you have a question to Pui Yan, and she'll respond to your question. So without further ado, let's all meet Pui Yan Leung from Vertex Ventures.
Hello. Thank you for being here. Actually, fun fact, I have known Kickstart team and loved them for a long time. Before I joined Vertex in 2020, I spent a long time with a telco called Singtel, Singapore Telecom. And of course, Globe is part of that family, and we've gone a long way, and we always talk about Raid the Fridge. I've seen pictures and videos. Finally, to experience it is awesome. So thanks for the invitation, Minette and Joe. So here I am talking about debunking 10 myths about Series A fundraising. And I want it to be more of a conversation because actually every market is a bit nuanced. So really look forward to learning more about what's happening in the Philippines. But before that, I should, share a little bit about my firm. We don't have a presence here. We haven't traveled here throughout COVID. So this is a time for me to reintroduce ourselves as a fund. Vertex Ventures is actually part of a bigger family called Vertex, and we have global presence. Well, let's dial back a little bit. Vertex as a brand started actually in 1988, so that predates many things. But back then, it was a very different setup. It was a VC arm under Temasek, which is the sovereign fund under Singapore. But it has gone through a bit of a restyling, let's just call it that. And right now we operate as a network of funds. So over here globally, we have 6 network funds. I am part of the Southeast Asia, and in the team, I would look exclusively at opportunities in Southeast Asia and India. And then we have also Israel, China, US. We have 2 global funds, growth based in Singapore, but they do Series B plus and above, and a healthcare vehicle. So all in all, there are 100 of us running around. Actually, I haven't met some of my colleagues because I joined just before COVID. We will be meeting later this year in our global summit. We have about 5 billion of AUM and more than 200 active portfolio companies. Stringing all this together is the entity called Vertex Holding. I have a colleague here as well, so I'll please say hi to him later. And they provide some shared services that support and propel the network funds. So for example, partnership, we have access to the Temasek network, we have access to all the portfolio companies. There can be synergies, there can be business opportunities, and they support us in that aspect, right? So Okay, a bit of this is the Singapore and Southeast Asian in the team, right? This picture was taken just about 5 months ago. This is me right here. And the reason why I was trying to hide behind was because I was 9 months pregnant at a time, going to pop. So I was trying to hide my belly, and then I'm back here. So the Southeast Asian India Fund was founded in 2010. There are now actually 22 now. We just have someone new join us. There are 4 offices: Singapore, Indonesia, India, and Thailand. We really believe that actually for us to be able to be effective as investors, we can't be a tourist. So actually part of the mission here this time is to figure out what is the best way to approach the ecosystem here. That's why we also rely on friends like Kickstart to advise us. We are sector agnostic fund. We focus on Series A, 80-20 rule. 80% of our investment are Series A investment, and then sometimes we go a bit later, sometimes we go a bit earlier. But because of that, we only, our only constraint, let's put it that way, is the geography. Southeast Asia and India, we can invest in any sector, right? So, and I'll give you some examples. Is that the next slide? Yes, this is the next slide. So, well, looking back at what we have invested, we have a lot of consumer internet companies. So at the beginning, you will have the platforms, but very soon it evolved into D2C, right? So RPG is a company based in Malaysia. They're a house of brands. So they have an apparel brand, they have a water bottle brand, and they, sell to over 40 markets globally. Daily Box is a not really cloud kitchen, but it's a daily bento sort of a concept. They have a range of food concepts that they operate, and they do purely a mix of stores and delivery, but a lot of deliveries in Indonesia. MeTube and TipTip are creative economy companies. I think there was a question about that later on. We're happy to talk about that. Rate is a social commerce company. So this is a consumer. And we have a lot of enterprise and B2B services as well. So there are mainly 2 types actually really. So they're the pure SaaS, and we have a lot of that from our India office, right? So some of them, would maybe expand into US straight away, but they are pure SaaS and enterprise solutions. Then there's another bucket, which are more targeted at MSMEs. So tools that enable the Saris of the world, the Warung in Indonesia, to be more productive. So we have a bunch of tech-enabled services. That's that. We have a lot of fintech companies. I was mentioning that you name it, we have it. So we have you have payday loan, we have SME lending, which is Validus. We have buy now, pay later. We have education loan company. We have save now, buy later. We have a platform, and we have an insurtech company here as well. So it's a pretty comprehensive fintech portfolio. And then these are the 2 newer sectors that we have focused more on in the last couple of years. Health, for obvious reasons, right? So give you an example. Speed Dog is a Singapore-based company which bring the hospital to your home or wherever you are. So the thesis is that telemedicine can only go so far. At some point, if you need care, you have to see a doctor to look at your symptoms, to give you primary care. And then we are back to square one. You go to the hospital, you wait in line for 2 hours to get a slot, and then, and you're none the better. So what SpeedDoc is trying to do is sort of flip it around and say that I can bring the doctor and the nurses to you where you are, and they use tech to sort of manage the efficiency of that. That's SpeedDoc. And IU Health is an India-based company. They target the tier 2, tier 3 small boutique run hospitals, maybe 20 to 50 beds, not chain hospitals. They serve only around their region. They don't have digital tools. They are not able to draw demand from neighboring cities. So what IU Health come in to do is they talk to all these small hospitals and say, okay, I will give you a digital tool to manage your workflow. I will give you some SOPs to make you more professional and productive. I will provide marketing for you. So if you're good at one specialization, I can draw demand from you, and I can help you do group procurement because now all of you are under my brand. And so they have a network of hospital without owning actually a single hospital. So that's fantastic. So this health. And we are also increasingly looking at sustainability. we have we consider agri-tech as an agriculture as or a subgenre within sustainability sector. Aruna is a fishery company based in Indonesia. Sorry, am I standing too in a corner and you can't see me? So Aruna is a company in Indonesia. They work with smallholder fishermen, sometimes provide financing, and they aggregate their supply and they give them market access to export the fish. Tiny Hub is a similar one, but for local market and focusing on groceries instead of fish. Licious is an India-based company. It's a chicken company, and they work directly with farmers to source the chicken. And the difference here is that they're a brand. So when you want to consider getting chicken to cook or to eat, you can consider buying Licious chicken, and that's a gourmet brand, right? Yeah, and we have our first climate deal going to be announced. The company actually aims to democratize the way carbon credit is, the fact that the carbon credit market today is not really accessible to smallholder farmers. If you have a land and if you want to get your carbon credit certified, today you go through a consulting process, and that may take 24 months, and it costs $100,000, where they have, sensors, productivity tool, and it can bring the cost down to between $3,000 to $10,000, and they do it within 2 weeks instead of 3 months or 1 year. So they're going to unlock potentially a lot of credit supply, first in Indonesia and then hopefully in the region later on. So in fact, if you then add this 5 sector up together, it's everything under the sun, hence we are sector agnostic. That's what I mean, right? This categorization is kind of like, okay, what are we looking at? Where can we build domain expertise? Oh, okay. So that's the end of my introduction of Vertex. Do you have any question before I go to the next segment, which is the topic of today, debunking myths? Any question about Vertex at all? We also have a Q&A segment later on, so either now or later. If not, I can carry on. Yeah. Okay. So actually, I'm a bit embarrassed because I realized that there are also some investors here, so it's a good mix. So feel free to disagree with anything I'm gonna say. Right? It's a discussion. But these 10 myths is some of them are really close to my heart when I look at the way founders try to do Series A fundraising. And I realized that there may be a Series A gap here. So I think this could be quite sort of suitable. So hopefully it's a useful conversation, right? So myth number 1, right? So we went through about probably, 18 months of euphoria in the market where everything was expensive and decision had to be made yesterday, right? So the fact that the bigger the round size, the higher the valuation, of course, I think a lot of founders want to optimize for that. But it's not always the best strategy, even from a founder perspective. Yes, you want to minimize your dilution. You want to encourage a team. You want to have a bigger announcement about your fundraising round. But you need to think about what happens to the round after that and the round after that, right? If you are making an investor pay future valuation, pegged against future performance, then if you don't make that performance, then you may have to do a flat round or even down round. And that's like the worst kind of news that can happen if it goes to the media or people talk about it, right? So the conversation that I have with founders is always, actually, how much money do you really need to get to the next milestone? So are you trying to, depending on what state, Series A, right? So are you trying to prove your current, the product market fit of your current product line and adjacent product line? Or are you trying to prove that you are already strong in your home market but going to a second market? What are the key milestones that will get you to the next round that you're trying to prove with this fundraise? How much do you need to get to there, and then add a little bit of buffer? So that's sort of your baseline, right? Then of course, then we can adjust. But that is, you need to have a sense of the use of fund. I guess that's the first question. Question on the milestones as well. What decisions are you making to decide on those milestones? And what is the current traction and growth momentum, right? So if you are kind of chucking along, then you can't expect investors to pay future valuation. If you're growing very fast, of course, you have a better negotiation position. And what would the following round look like? I think you kind of need to think at least 2 rounds ahead. That's my opinion, right? If you raise now, okay, I don't know, for argument's sake, 2 million on 10 million valuation post, right? So then next round, how much do you need? And then how much dilution you want? So maybe, I don't know, 30, 40. And then what is it? And you also kind of need to think, and I'll cover this later on, but what kind of returns are you giving your investors, right? If your valuation is too high, then they will need to push you to grow even more. And sometimes you make wrong decisions so that they can try to get you to a higher valuation so that they can exit, right? So I think this is a big myth. It's very tempting because from company inception, a founder has 100% shares, and then you see yourself dilute 30%, 20%. You want to minimize the dilution, but I think we can always play around with the round size. I think that's something that we do quite often. We actually ask the founder, how much do you really need? Right. So that's myth one. Stop me anytime, disagree me anytime, have a conversation anytime. So happy to chat. Now, myth two is that obviously when before starting a company, if you're an angel or a seed investor, if you're a venture builder, founder profile is always important. And you talk to any investor, they always say we focus on the founder, right? And it's true, like founder profile, background, motivation, founder team dynamics, and super important. But a lot of founders feel that by Series A is no longer that important because I can use traction to show that the business model is legit, or I can use other things. I can show my level 2. But actually, as an investor, we are a Series A investor, we spend unproportionately large amount of time trying to triangulate and understand the founders as people when we do our due diligence. And it's not like, stuff like, does he have a criminal record? Is this red line? But it's a conversation. We understand, how did you get here? What made you decide to start the company? What made you decide to, choose this co-founder of yours? How did you get together? And why are you doing it? Why are you trying to get to it? If resource is not an issue, what is like the dream outcome for you in 5 to 7 years time? And I think, it's important because I have a lot of respect for founders because I don't think they can be one, right? It's a very punishing journey. You don't sleep, you're always thinking about your cash flow. You have to deal with all these investors who ask you either for reporting, one type, or growth, another type, or a mix of both, the third type, right? Like you're dealing with all this and then you have difficulty hiring. Everybody is trying to ask for your ESOP, then you have to dilute. So there's a lot going on and people are depending on you. And it's not a journey that you can just call quits. Well, some founders do, but like if you want to do well, it's a 5-year journey, 7-year journey, 12-year journey, 14-year journey. Some of our portfolio companies have backed more than 10 years before, and they are now doing very well, but their journey was not the bed of roses, right? And so that's that. We have to have we as investor, I would like to know, I look you in the eye, I go, okay, I think can he handle it, or can we handle each other? Or can the co-founders handle each other? If they have a disagreement, who's gonna make the decision? I want to highlight this point about equal shareholding. We ask that a lot. Like, you guys are friends since college, you play soccer together, and then you know each other for a long time, you're best friends, you never argue, you'll find a way to resolve. But then we will ask a few things, like who is in charge of what? Is it clear line of responsibility so that there's not muddle? We also ask then, when you can't agree, who make the decision, right? When they say, it's okay, we will always agree, then we'll ask, okay, but you will not agree, so then how do you decide if there's a deadlock? It's okay, we'll find a way. And sometimes there is no title, right? There's no title of who's the CEO. They're all co-founders. Then we say, okay, who's the CEO here? We haven't decided. We're kind of like, we're just, each responsible for our own unit. It's all good. And that is how it actually functions in many cases in the early stage of the company. But I think at some point, sometimes hard choices will have to be made. And hard choices could be, do I take this investor's money over another investor money? Someone is non-performing, but this person is employee number 2. Do I let him go? How do I do that? And you will never always agree on things. And we all, it's a bit contrarian, but we all love democracy, but many times they cannot be democracy. Sometimes someone have to decide. So then we will ask who has a bit more, or even if it's equal shareholding, then someone has to be able to say, okay, as an investor, I know who I could deal with, when sometimes hard conversation need to be had. So yeah, and then looking at the skills, the network, usually we will say, okay, it's good to have a commercial founder and then also a technical co-founder that's complementary to each other. Are they able to attract the second layer? The question is also why would your layer 2 want to stick with you, right? Is it only through ESOP or you pay over the moon for them, right? Talent is I don't know, recently there's a lot of news about big tech companies laying off people, but yet it's still hard to find good talent. Good ones are very expensive. So we have limited resources, and if they don't perform, you let them go, you waste 3-6 months. It's happened to some of our portfolio companies. So, why would they stick around? Why are they the right fit? So founder profiles are actually very, very important, even at Series A. We would like to understand founders. We would also like them to understand us. So we have a lot of conversation, we go out for coffee, and we may not even talk about the deal itself sometimes, right? We want to try to figure out whether we can work with each other and we have a good level of understanding. So that's myth number 2. Any questions? I realize I'm powering this through very quickly. I only have 10 myths. Yes.
So, hi, I'm Red. Just want to clarify about equal shareholding. So I guess the sense I get is that you strongly prefer in equal shareholding where there's one co-founder with like a slightly bigger equity stake, right?
Yes.
Okay, gotcha.
I think it depends on the investor. So not all investors may have this preference, but we, based on what we have observed, it usually works better that way long term, right? So sometimes we try to fix this, not a mistake, we realize that, oh, really, the contribution is different. Then you try to unwind it. You can't, it's not so easy to unwind. You start with 50-50, you can't just say, give me back 25%. It doesn't work that way. So, but it's not easy. But I have also seen, and I have to say, I have also seen, and this is a real life example, a equal shareholding all the way to the end, and they have found a way to make it work. But it gets complex, right? So they will put in place things like call and put mechanism, right? So yes, equal shareholding, but what if, I argue with you and then you'll get, okay, let's have a divorce, let's walk away, right? Then you are left with half the, you have half the capacity of the founding team gone, and then what happens? So I have seen creative mechanism like, okay, if this happened, then actually the other founder can just take over your shares for free. So they're kind of economically tied at the hip, right? So you're very disincentivized to make very rash decisions to say that I just want to argue with you for the sake of it. They really make decisions together and for the good of themselves, and also for the company. So I have seen mechanisms like that, and they are still equal shareholding, I think. Yeah. And this is very late stage company. So it's not to say it doesn't work, but I guess what I'm saying is there must be a long lasting way for the founders to deal with disagreement, right? Hard choices, hard conversations. If you have found a way and you keep equal shareholding, fine, right? If not, then the next easiest way is to have different shareholding, maybe. Yeah. Okay. Number 3. Yeah. So this is maybe a bit contrarian. So, but not to say that Vertex doesn't appreciate traction. Traction is very important to us. Like I want to stress that. But storytelling, I think many founders, underestimate the power of storytelling well. And it has to be consistent. It has to be done well. Every time it has to be authentic. Authenticity is so important because it's true. It represents your mission. It represents your motivation. It represents who you are. You won't deviate from it because it's real, right? So, let me just give you an example, right? If a company A come to me and go, okay, I've solved problem 1, 2, 3 with solution A, B, C, right? I have done this for 12 months after raising my seed. I've done well. I have achieved my goals. Now I am here. And I think I want to get to here in the next 12 months because I'm raising funds for 18 months. So this is my buffer. I will do step 1 to 10 to get to here, and I'll be able to raise Series B. Very good. And you tell me all the, you have legs, right? Your story has legs. You will hire people, you will have channel partnership, whatever it is, you have the right pricing strategy. Okay, so that's good. And then that's it. That's good. So I will have not much risk, right? I have, if I believe you can achieve that, and I believe in your strategy, I will be able to see the value of my investment grow from here to here, right? And then many times it stops there because the founder gets so fixated on showing that their business plan have leaks. Then you go, okay, what's next? What is the big dream? And you go, yeah, well, I will, we'll figure out along the way. We're very nimble. We will, we will be able to iterate and we'll see what the market wants. And then you go, what's the big vision? You see, venture is a business where we are trying to change the world. Sorry, it sounds very cliche and sort of mushy, but you want to disrupt something, and then you want to be disruptive, you want to change the world, and you could either fail spectacularly or you can, you go to great heights, and you must be excited by that vision. So some founders get fixated and then their vision statement get very lost. And it's very muddled, and it can be, oh, one pathway could be this, one pathway could be that, and then I have 10 options and I'll see which one works. You'll get so distracted. And me as an investor, I don't know what journey, what vision I'm buying into, then it becomes a bit incremental. Maybe it's in there somewhere, but maybe you're just not articulating it. So if you are able to, alternative, like founder B come to me and say, yeah, I raised seed money, I did this to get here, I'm going to do this to get here, but actually this is just the beginning. My end goal is here. Then it excites everyone. You know that you have a North Star for your team, for yourself, for the investor. It could still change, but you are working towards something bigger. It's important, and I think it's easier for also for the investors to see whether they're fit for you, because we may or may not buy into that vision, right? So I forgot to scroll. So, so this is it, right? Like I'll ask, what's the big vision? Why should I care? Why does it matter? And okay, you have this big vision. You are the first mover. And I think there's opportunity in Philippines, actually. I think there are a lot of opportunity for startups to be first movers here because it's still quite nascent. But how long will it take for someone else to copy you? And what do you do when it happens? If your vision is big enough, maybe you can run faster than them, right? So that's myth number 3. Okay, so then this is like a bit of the opposite. So at Series A, burning cash is still expected, which is true. It's yes and no. It's true if you're profitable at Series A and then you're happy with that, then you're a lifestyle business, not a venture business. But the question that we then would ask is, okay, what is really the business model? Are you purely achieving your growth because of subsidies? So I don't know, back in the day, during the initial days of the wallets, if I create a new wallet, you give me $2. So I create 5 wallets, I get $10 free for no reason. And then $10 is down the drain. That's VC money. Is that a good business model? I don't know. So what does the unit economic look? Then we also try to dissect what is fixed costs, what is variable costs, and what are your levers to get to profitability? You don't have to get to it now, and then you have the 3 layers, right? Like PC1, PC2, PC3. We try to understand that. And then what's your cash runway? So if you are burning, I don't know, for argument's sake, 50K now, do you need to increase it? How much do you need to increase it to get to your next goal? So we'll ask all these questions. So yes, we expect you to burn still for growth at Series A, but for good reasons. Because, and someone told me this, I'm just going to lift it off. If she's watching, then sorry, I'm plagiarizing. Someone said before that startups are actually a resource allocation machine, because at up to for a long time, you have limited resources. You usually will have less money than what you really want to do. Then it's all about making the hard decisions about the trade-off and how you burn, right? So it's not just burning, but how you burn is important. Okay, this is a obvious one, like, being strong in the home market is good enough. I think being in Southeast Asia, we are 600 million people block. I guess outside of Indonesia, the population for any one market is just okay, right? Okay, Singapore is miserable. We have only 5 million people, right? But I think in Philippines, I think it's about 100 million, right? So, but the reality is that a lot of the activities happen in the metro areas, right? So you can't just assume that if you're in Philippines, you have your TAM is 100 million people. So then, I don't know, maybe 20%, 80% come from the metro, 20% outside, or maybe it's even less, 20-80. So the message here is, what is the real TAM, right? So if the TAM in your home market is small, then it's time to figure out how to increase that TAM, right? Either you stay here, that's okay. Then do you have other product lines to roll out so that you can increase the TAM, or you go out, right? But actually, I've come to know that in Philippines, actually, the TAM for certain sectors, for certain business models are actually very large, maybe even larger than Indonesia. So then that's okay, right? Like it's a choice that, and you as long as you know how to attack the market, that actually leads me to the next point, because the next myth is exactly the opposite of this, that I must be in like 10 markets by the time I raise Series A. It's completely wrong. Because again, startups are resource allocation machines with limited resources. Is about how you pick those market, right? So, what are the trade-offs you have made to come to that decision, right? Is it Philippines plus Vietnam? Why Vietnam? Is it, why not US? You're English speaking, why not the US? Why? And what is the cost to prove out this market? So I had this exercise with one of my portfolio company recently. It's a B2B company. They wanted to expand from market A, which is Singapore, to market B. And that market has very different employment laws, have very different willingness to pay for SaaS services. And it's just a different setup. So in order to penetrate a market, you either go through a partnership, which is, it's also not easy to find the right partner. But at the time, the decision is, okay, maybe we should set up our own team there. So the question I asked, and that's not the only important question, but the question I asked is, okay, if the labor laws are very tight, if the cost of setting up is, it's not easy, you have to set up a legal entity, you have to have a local director who's not working for you, what is the exit strategy if something doesn't go, if we have decided, okay, so first of all, at what point do you realize that the market has worked for you? Or at what point do you say the market is not working? So, do you say that, oh, okay, at this point, I'll know that I'll continue to, put more resources and double down on this market, or go, okay, this is enough, I'm bleeding. At what point do you stop? And at that point in time, how can you stop? Do you have to pay 9 months severance because you lay off the team? Do you have to pay, do you have to go through a process just to liquidate your subsidiary there? What is it? And can we afford it? If we can, then go for it. And then we will just make sure that we support you all the way until the point where we say, okay, we need to reassess, right? Yeah, so it's not necessary to just to force feed your fundraising deck to say that, oh, I have all these logos. And actually during this week, I had the opportunity to meet many amazing founders here, and they're doing great work right now. A lot of them are pre-A stage within the home market. And there's so much more that they can do just to tap the different segment in the home market alone. And then on the last slide, they'll go, oh, but I just don't want to be a Philippines company. I want to be a regional company. Then they show flags, right? Which is fine. But then I ask, okay, how far actually is that away? Is that your next 12 months plan? Then they actually know it's maybe 3-4 years, which is okay. Then we kind of know what it is. Maybe we can accelerate some of it if we see certain indicators, but I think it's a strategy of what you want to focus on with the limited resources. Okay, I love this one. I'm a nerd, so I like to go through Excel models to understand the business drivers. And I can't tell you how many times I get, like I will pull my hair and go, why does the strategy written in the deck not correlate at all to the Excel spreadsheet that's being sent to me? I'm trying to go, okay, this is the channel strategy, this is a pricing strategy, this is a market strategy, this is your resource plan. And I cannot figure out where in the Excel spreadsheet I can play around to do sensitivity analysis to go, okay, well, if something go right or go wrong, what do they mean? I have no way to do that. And then I have to go back to the founder with clarification questions. And then they get irritated because they're like, but it's Excel is not going to be right in 5 months' time. I know that. Yes, all the business plan, you know, it won't be the right number. But it is, and I don't think everybody does it my way, but I think the concept is I need to be able to have a conversation with the founder about his or her assumptions in a very, very detailed and specific sort of way. And maybe my way is to use the business model to have that conversation because it's very precise. Like, oh, you think that you can achieve PC3 in, positive in 8 months time. Why? Can you show me where are the drivers that go into that, and I will challenge each other's assumption. That's how I do it, because then I can see all the assumptions in Excel. So like I would like to tie, and I think it's important for you to, because you pass this as a budgeting sheet to your finance manager or your CFO, who would run the budget and make sure that people behave accordingly, don't overspend, they hit the target. So if your strategy and your budgeting is sort of in two different dimensions, there's no way your CFO can do a good job to sort of manage that resource allocation. So I think you need to reflect, and the business plan needs to articulate your strategy and show what are the key business drivers, your pricing strategy, and I think I like to play with Excel, so nerdy, because then I can do sensitivity analysis. So I go, okay, you assume that, again, let's say you sell, okay, Licious, right? 1 box of chicken, ready to eat chicken meal at $3.50 US, right? But what if there's competition and you need to cut it to $2.50, and then the costs go up because, now supply chain issue. So instead of, X% margin become Y, how does it look in 2 years' time? Does it mean that your runway suddenly from 24 months become 9 months and you need to start raising funds, and we need to prepare for that, possibility? So I like to do that. And I think I also like to ask founder whether they have thought about that possibility, right? So and therefore, to me, financial modeling is not a paper exercise. Yes, you have a question? Is it? No. Okay. Okay, yeah, no, so that's it. And it's still, and I talk as if, all my portfolio companies are behaving right, but it's not true. Until now, they do the annual budget, and I'll go, excuse me, haven't we had that conversation before when I did fundraise with you? Like we have to be a bit more, we have to be more specific. So maybe that's my style, but for me, this is royally important to me. Yes, please.
Actually, yeah. Let's read again. Is there any particular part of the financial models that you look at where you could actually tell, or like you could use to figure out if the company's even ready for a Series A in the first place?
Great question. So I would, and I say this because I come from a corporate background. So but the same method works for me, right? So I would see what the historical is. So many times, actually, the founder will give me, let's say now it's, already, okay, it's not a good example now. So let's say we have a conversation in June 2022, right? They open the data room and the Excel modeling, it starts January 2023, and they don't give me anything before January 2023. Then I go, can you give me historical performance? Then they'll give me a 5-line Excel spreadsheet, revenue, costs, and bottom line. And then, so actually the first thing I'll do is to understand the current situation. I'm not looking at the future yet. I'm trying to understand the lay of the land first, right? Today, if you earn $100,000 a month, Where is it driven from? Is it from revenue model A, B, C, or which market region? I want to understand that. And then I'll go, okay, this is your exit, sort of your current scenario, and you're projecting January 2023 to be that. How realistic is it to get to that, right? Like or it could be from here to here, then I go, okay, how confident are you to achieve that? Or it could be flat and I go, are you too conservative, right? So I will look at now, right? And also for the costs. And then I will look at, your question is whether they're ready for a Series A fundraise, right?
Yes.
Okay. So actually, in a way, Series A funding is, how to define Series A? I think we all say we know what it is, but I think we're all just saying in general terms. But generally, Series A fundraise refer to companies that are no longer a PowerPoint company. They have some traction, right? They have some proof that their business model is working or not working, and then they are expanding the product line. Maybe there's a general definition. So in many sense, even without looking at a financial model, you're probably ready for Series A fundraise when you need to raise funds for Series A's, because you would have like a deck and you go, okay, I have done this, I've done that. So, but the question is, I need to build conviction that you can be a fund returner, right? So that's where the conversation happened, and I test your assumptions. So I don't think there's one or two items where I can see from the business model where I go, yeah, this is not a Series A company. Not really that, right? But if the founder is not able to correlate what happened in the past to what will happen in the future, that's one red flag for me, right? So sometimes they'll go, yeah, but I'm not the financial guy. I will leave the CFO to it. But I think as a CEO, you need to have ownership of the numbers. So you need to have some sense. So if you don't know it, then please get your CFO to educate you on how to read the numbers, right? And I think maybe the other thing that I'll look out for is the projection. So back to the vision, right? So I'll go, okay, now it will be 2022. So 2027 here. What is your top line and bottom line, right? So you could be nothing today. So you could be, $1 million ARR or whatever it is. Then what happens in 2022? Sometimes I will see business plan that say, I'm a $10 million business, right? It's great if 10 million comes to be. If I'm 10 million, I'm very happy, I go home, right? But in the venture business, 10 million, what kind of multiples do I get to return a fund? It becomes too slow. Then there's maybe a vision problem, but maybe there's no vision problem because the vision that they tell is very big, but it doesn't translate to the number. Then something is wrong. So it's more like playing detective work a little bit. And then I use the deck, I use the conversation of founder, I use the business model to try to triangulate where it could be the red flag. On the flip side, some founders will say that they will have $1 billion revenue by 2027. And I've seen a few of that. And then you go, how, why? And then after you strip down, because I recognize my revenue that way. That's not how you should recognize the revenue, or, that's how I'll do it this way, that way. And then there's another red flag. So it's really a conversation, is a channel, is a platform for me to have very specific conversation with the founder. And then if everything is a mess, and then if the founder also has no sense of the number, then it's also a concern. Like by Series A, I think the CEO need to take some ownership of understanding, be very specific about the business model. So that's a non-answer to your question.
Thank you. Actually, it's definitely an answer.
Hi, I'm from Robinson's Land Corporation. So I just recently learned about this financial modeling stuff because I'm not really a finance guy.
You're not
But
finance guy.
for the financial modeling, I'd like to understand from what you're saying, I believe it's more of the P&L as well as the unit economics. Then you look at the consistency of the projection from the P&L and the unit economics, right?
That's one part of it, yes. So I will look at the growth, which is the ambition. I'll look at the unit economics to understand the pathway to profitability. I will look at the cost line and understand what you are spending on. So are you spending on tech? Is it, if you have a super bloated tech cost, can you even hire that many people anyway? What if you can't hire, right? So it's all this element. Yes, I spend a lot of time on the P&L, but then I will also look at cash flow. especially if it's a company with traction, then you will have, and a balance sheet also, you will have a cash position, you will have a AR, and you have an AP. So especially in consumer business, it's not enough to just look at the EBITDA on the P&L, because you need to actually understand how much cash is on hand, and with that, how much debt you have. So let's say you are raising 3 million for argument's sake. And then I assume that all these 3 million will go into working capital to fund the company. But if I open the balance sheet and then you have a $2 million debt, then we only have $1 million left to pay into growth. So everything, right? I'm not a finance trained, by the way. I graduated with an engineering degree. So I don't actually, this is live, so I should say that. So I'm not I'm not good at a lot of ratios, but it's something that you kind of over time, you kind of need to know what to look out for, and just red flags. And then I think then internally, of course, and to sell my firm a little bit, we have been around. So we have a lot of wisdom within the team. We have a lot of experts in different sectors. So we collaborate, and then we kind of figure, hey, for this company, is this kind of ratio, right? So for example, a D2C company, what is considered a healthy margin, right? Is it 70%? Is it 65%? Is it 40%? Is it too low? So we will need to see enough to understand what sort of like a market benchmark. Then they go, okay, you're too low. Why are you so low? Then we have that conversation. So it's a mix of everything. Yeah.
Makes sense.
Thank you. Another non-answer to your question. Sorry.
No, it pretty much answers my question, because I still understand where you were going.
Okay.
So basically, it's more of looking at everything so that we can have the consistency of the
Yes.
story, and to see how the founders and the startup itself
Yes.
is actually working, right?
But it's a painful, I understand it's painful to put together Excel. Like you have to run your business, hire people, deal with all these issues, and still do Excel. That's like the worst. So I don't know how to solve that, but it's an important piece of document. Yeah. As you can see, it's very important to me. I've been standing in front of MIF 7 for so long. It's yeah. Anyway. Okay, shall I move on? Okay, so this is I don't know. You wouldn't normally hear it from a VC maybe, but I think one myth, like even before you start to try to raise VC money, is to ask yourself, do you need VC money? Is VC money for me, right? So VCs have LPs to answer to. We don't come up with my own money, right? We do a little bit, but then a bulk of the money come from investors who believe in us to return money for them. So we have to show returns, right? And in startup world, there could be so many failures. So every company that we back need to be a potential fund returner, right? So we therefore will drive our company a certain way. Like, we as a fund, we don't believe in subsidizing for growth or, just growth at all costs. No, that's not us. But you need to grow so that you can at some point bring us an exit. That's the reality of the situation, and we will need you to think big. We will need you to get to a certain top line. We will need to drive you to get to sustainable growth and profitability at some point in time. So, you may have a lot of nice project that you want to do, which then we say, no, we can't because we don't have resources for it. You lose control, right? At Series A, you probably by then dilute 20, 25%. And as you go on, you will dilute more. By the time you exit as a founder from 100, you may own less than 15%, right? And every round, new investor come in, they have more requirement, more reserve rights, right? They want a board seat, they want, veto this, veto that sometimes, or they want certain, they have reporting requirements that may be daunting for some. So it's and it's a relationship that you will keep until either your company exit or die, right? Or the shareholders sell the shares. And it's not a short relationship. For many founders, that's probably the longest any relationship they have, right? With a deal manager, then their maybe own life partner, right? So then the question is, is that for you, right? You don't have to raise from VC if you can bootstrap along the way and you have more traction, or if all you want is to, to if that kind of growth profile is not for you, then you should think about whether you want to take money from VC. So I think that's bad for my business, but I think this is rather than to waste your own time to do the deck and then try to chase, and then you realize, oh my goodness, why are the VC so demanding, right? then have that chat with your co-founder, have that chat with your family, and ask yourself this question, are your growth ambitions aligned with the investors? What return expectation can you promise the investors, right? And then look at understand what kind of relationship you will have with the investors. Some investors are very involved. We are quite involved. So we have a very concentrated portfolio. We work very closely with our founders, open doors, strategize, whatever you need. We sometimes, I heard that some founders will call us co-founders, right? Because that's how involved we are. But that's just one way of investing. We take a board seat and we are very active. But there are those that are more sort of indexing approach. They will go, okay, I like fintech as a sector, and then I will go, I have 5, portfolio companies, and then I won't really ask you too much questions. So I'm the kind of investor that will let you do your thing. That's also fine. That works for some funds, right? Then you have to decide what kind of, people you want on the board, and work with you, right? So that's important. Another myth, I guess, is I should do my homework and I should only pitch to the right VC. That's actually generally a right mindset. So you shouldn't, just let anyone into a cap table, because once they're in the cap table, it's hard to kick them out. But when it comes to pitching, I think the message here is to keep an open mind, right? Like, I'm sure in life, I guess, you have come across many conversations where you kind of expect nothing out of it. It's a waste of time. 1 hour of my time is okay. It's a warm intro. I'll take it anyway. And then I'll forget about it. And then it turned out to be maybe the best conversation you have. And then you end up doing something together. And sometimes it's like that, right? Like, and I think at very early stage or so, you may not know what is the right profile for you. So, and you also need to practice a pitch. So I think all in all, it's like sales, it's a funnel. So you talk to 100, maybe 50 will respond to ask more questions. And then, so it's a little bit of a numbers game, it's a little bit of warm intro, it's a bit of targeting, it's a bit of art and science. So, don't be super choosy about who you talk to, right? And just keep an open mind. And do your own due diligence on the founders, but have that conversation and then you decide, right? I'm not saying that you should talk to everyone in town, then it's really very resource intensive on your part as a CEO, because you still have to run a business. But I think if you only think that you can, I will go with the A, B, C, and then one of them will give me a term sheet, that's usually the wrong assumption. Maybe none of them will give a term sheet. So, and also, it also depends. There is a not so nice saying that says beggars cannot choose, right? So if you have not like short runway, then let's be pragmatic about the situation as well, right? And see what are the offers on the table. I am actually coming up to my last myth, and again, this is not good advertising for me as a VC, but again, I kind of this one got inspired by a friend of mine also from the industry. It's not true that VCs have all the right answers. I guess the advantage maybe we have is that we see a lot of startups. That's our job, to meet startups on a daily basis. So there's some pattern recognition that we can apply to go, yeah, okay, this doesn't look right. But for a specific situation, it's always very nuanced. So we never really have the right answer. And that's where, we need to, if we become partners, if we become investors, that's where a lot of collaboration will need to happen. We need to problem solve together. And here's where I'm advertising my firm here. Like, I want to stress that we are a super hands-on, fun. Actually, sometimes when founders talk to us, they're not sure about us. They'll go, oh, Vertex has been around since 1988. You must be like a dinosaur. Why should I work with you? And you go, okay. please talk to some of our founders. Like, I shouldn't be telling you how I work. Like, talk to pick any founders that you want to talk to and make an introduction. You guys talk, and then figure out who really are the good and the bad, the ugly, and then we, most often the answer that come back would be, yeah, I think actually Vertex really try very hard to, and we genuinely bring value. We try to figure out what doors we can open for you, what talent you need, we try to find. We be a sounding spot. I'm on WhatsApp with most of my founders all the time. There's like no, and after what become a conversation, it's not oh, can you give me an update? It's not like that. So we don't have all the answers, but we do our best to leverage our network, our experience, our expertise, our portfolios to figure it out. And I think that's why we are also here to understand what the opportunities are, what does the community here care about, what are the opportunities that you see, what are the challenges, so that as we engage with the ecosystem more, we know how to be the best partner to the ecosystem here, right? So that's kind of like my last slide. Okay, so I did this before I landed on Monday. So but I think having spent a week here now, I can feel like the energy is super different from pre-COVID. There are, many more founders, many more ideas, more conversations around the startup community. So I think generally we are pretty excited to spend more time here. And I think I want the rest of the, so evening to just be a conversation. And we're here to learn, we're here to partner, we're here to talk. Yeah, so thanks. That's all I have prepared actually. Oh, no, sorry. Hang on. Elise, my comms director, has prepared this for me. So I didn't put my own face on a slide like that, but there is a QR code. If you want to continue a conversation with us, you can get my email, but here's a QR code, scan, and we can keep talking. Yeah, so that's all I have. Thank you.
Excellent talk, Pui Yan. Thank you so much. We will change equipment. So I invite you to take a rest, drink water. I know it's okay. Just give us a moment, guys.